Okay, let's dive into this. Welcome to today's Explainer, where we're basically going to put on our detective hats and investigate one of the most fascinating and honestly kind of perplexing cases in the market right now. We're looking at the skeptical investment case against the mega-cap tech darling trading under the ticker SPCX. When a company reaches this massive level of market saturation and just pure hype, it is so incredibly easy to get swept up in the story. But as focused learners, we want to look right past that narrative and investigate the raw data. We're going to build a financial detective story together, step by step, just following the data trail. We'll examine the valuation, the timeline, and a looming market event that could literally change everything for this stock. So let's start by looking at the sheer scale of our primary suspect here.
$1.8 trillion. I want you to let that number just sink in for a second. That is the market capitalization of SPCX right now. It is already a certified, undeniable mega-cap stock. And here's the thing about a $1.8 trillion valuation. The law of large numbers firmly kicks in. At this mega-cap size, the upside is inherently capped, unless the underlying fundamentals are absolutely bulletproof. I mean, think about it. It takes a monumental, world-shifting amount of new capital to double or triple a company of this size. You really have to ask yourself, just how much bigger can the pie realistically get? So what exactly is the alibi justifying this massive Bloomberg-style premium valuation? Well, every suspect has an alibi, and for SPCX, it's actually a very compelling story.
And here is that story. This is the bull case narrative that investors have absolutely head over heels fallen in love with. It's all about the TAM, the total addressable market. The vision here is massive. We're talking about commercial airlines universally adopting SpaceX Starlink as their standard go-to Wi-Fi package. And we are already seeing this thesis play out in real time, led by Frontier taking the initiative. It's a brilliant narrative, right? Captive audiences on thousands of flights, reliable, ultra-high-speed internet everywhere in the skies. You can instantly see why the market got so excited. I completely get this TAM story myself. It's exactly the kind of futuristic, inevitable feeling tech shift that makes investors want to just buy in at literally any price. But as financial detectives, we can't just buy the sci-fi vision without verifying the timeline. When does this narrative actually print cash?
Well, look at the gap between the current hype and the actual financial payoff. We've got current operations in 2024, continued expansion slated for 2025, and revenue growth penciled in for 2026. But the actual bottom line profit, that doesn't even materialize in 2027. That is a really, really long wait. Investors are currently paying a $1.8 trillion premium for a company where the actual net income is still years away. You're essentially paying upfront for years of absolute, perfect execution. And if there is a single hiccup in this timeline, maybe a delay in airline adoption or a sudden macroeconomic shift, that long wait until 2027 could feel like an absolute eternity for anyone holding the stock right now. So if we are waiting all the way until 2027 for profits, how exactly is the market valuing the company today?
This is where our investigation really hits a wall of financial reality. We are comparing SPX's projected 2026 valuation multiples against another famously high-flying stock, Tesla, just to put these sky-high numbers into context. SPX is trading at a staggering 47 times its estimated 2026 revenue. Compare that to Tesla, which is sitting at 14 times. And honestly, it gets even more extreme when we look at the EV to EBITDA metric for 2026. SPX is at 110 times, compared to Tesla at 97 times. We are talking about absolute nosebleed multiples for a company that, remember, isn't even slated to turn a profit until the year after these estimates. To price a stock this perfectly, the market is assuming zero risk and infinite demand. But beneath these sky-high multiples is a massive looming supply shock that the market seems to be completely ignoring right now.
We are staring down an impending avalanche of share unlocks. According to the data, 20% of SPX shares are going to flood the market in August. That's a massive influx of supply entirely on its own. But right behind it, by early September, another 44% of shares unlock. It is literally a late summer deluge of supply hitting the open market in rapid succession. And in the stock market, just like in any other market, when supply dramatically increases while demand stays the exact same, prices face immense downward pressure. So what exactly does a share unlock of this magnitude do to the actual tradable shares?
The climax of all this data? 900%. Because of those August and September unlocks, the tradable float is going to balloon by roughly 900%. Imagine an exclusive, tiny little pond suddenly flooding and turning into a massive lake, but the number of fish stays exactly the same. That is the kind of dilution dynamic we are staring down here. The scarcity value of SPX is about to evaporate practically overnight. When you combine a $1.8 trillion market cap, absolutely no profits until 2027, extremely high valuation multiples, and a 900% explosion in the tradable float, well, the structural foundation of that share price starts to look incredibly precarious, which forces a rather sobering comparison.
As we wrap up our detective work here, we have to contrast the fantasy with reality. The data points out a huge difference between SPCX, which is carrying an estimated 2026 EV to EBITDA multiple of up to 120 times, and a dramatically cheaper stock like SKHY, sitting way down at just a 6 times multiple. It's basically a tale of two entirely different stock market realities. On one side, investors are happily paying 120 times future EBITDA, just hoping the company grows into its trillion-dollar valuation while somehow surviving massive float dilution. On the other side, companies like SKHY quietly trade at a fraction of that multiple. It forces us to take a step back from the glowing Starlink Wi-Fi narrative and just look coldly at the math.
Which leaves us with this final stark question. Valuation just has to matter at some point, right? A great story and a massive total addressable market are wonderful things, they really are. But they do not make a stock immune to the laws of financial gravity, especially when you're facing a massive share unlock that will balloon the float by 900%. We've laid out the clues directly from the source material for you today. The limited upside of a $1.8 trillion cap, the painfully long wait for profits, and the extreme multiples compared to peers. It is ultimately up to you to weigh the hype against the data. Keep questioning, keep investigating, and never let a really good story distract you from the cold, hard numbers. Thank you so much for joining me for this explainer, and I'll see you next time as we break down our next complex topic.